Blackstone, a giant in the real estate world with over $500 billion worth of real estate globally, is suddenly selling off properties in Florida at a loss and at an alarming rate. This is a glaring red flag waving over the Sunshine State's housing market, and it's making waves that could ripple across the nation. This isn't just a small market correction, it could be the beginning of a major shift in the housing market. In the next few minutes, we'll break down why Blackstone is making this move, what it means for Florida's real estate, and how it could affect housing markets across the country. Before we get started, thank you for liking and sharing these videos. It really helps out the channel, and consider subscribing so you don't miss these regular updates. Today, we're diving deep into a developing story that's sending shockwaves through Florida. Blackstone, known for snapping up properties and betting big on real estate, is now panic selling homes at losses. And not just any homes, houses in some of the hottest markets in the state. But why would this matter to you? Because when a giant like Blackstone starts offloading properties at a loss, it signals something big. Could this be the beginning of a massive housing crash similar to what we saw back in 2008? Or is it just a strategic retreat by one savvy investor? During the pandemic, when most of us were figuring out how to adapt to a new normal, Blackstone was scooping up properties left and right, taking advantage of a market thrown into chaos by low interest rates and a surge in demand for more spacious living arrangements. Data from 2021 revealed that companies like Blackstone acquired tens of thousands of homes across America, spending billions in the process. They weren't just buying, they were betting big on continual growth. But here's where it gets interesting. Fast forward to today, and the tone has dramatically shifted. Blackstone is offloading properties at a staggering rate. The shift from buying frenzies to rapid sales raises a big question. What does Blackstone see that the average investor doesn't? Are we on the brink of a major downturn, or is this strategic repositioning? To understand the gravity of this situation, it's essential to grasp the scale at which these institutional investors operate. They can dictate market dynamics. When Blackstone moves, it's like a whale in a pond, causing ripples that affect everyone, from the biggest developers to the smallest homeowners. So as we dig deeper into what's causing this giant to sell off its prized assets, remember, the decisions made by an entity like Blackstone could signal the beginning of significant changes in the real estate market, not just in Florida, but potentially nationwide. Blackstone and other institutional investors once snatched up nearly a quarter of all single-family homes sold in top U.S. markets during the peak of their buying binge. Now they're backing out, and the implications are huge. But why should a giant like Blackstone offloading properties at a loss matter to the average Joe? Because when a market player this big starts to unload assets, it's often a harbinger of market trends. Just consider this. In St. Petersburg, Florida, a property that Blackstone purchased for $380,000 2 years ago is now on the market for a staggering $110,000 less, and it's been sitting there unsold for over 170 days. This is becoming a familiar story in this sun-baked market. The broader data paints an even more concerning picture. Recent market analysis show that the inventory of unsold homes in Florida has spiked by over 30% in the past year alone. This glut of available properties is driving prices down, making it a buyer's market but a seller's nightmare. The rapid shift from what was a seller's market during the pandemic, with historically low inventories and sky-high prices, to this sudden surplus is startling. Interest rates are climbing and consumer confidence is waning. Inflationary pressures are squeezing household budgets, making big-ticket purchases like homes less attainable for the average family. Furthermore, the fallout from pandemic-era buying frenzies, fueled by cheap loans and a rush for more space, is settling. As a result, markets like Florida are now oversaturated with properties that no longer fetch pandemic premiums. Blackstone's strategy shift is particularly telling. They're selling off properties in a market they once heavily invested in. This signals a lack of confidence in the market's ability to rebound soon, which is a red flag for smaller investors and homeowners banking on their property's value. This trend is about a potential shift in the fundamental dynamics of real estate investment. The big question now is, what happens if other institutional investors follow Blackstone's lead? Could we be looking at a cascade effect that leads to a significant market downturn? As we continue to monitor this situation, one thing is clear: the decisions of institutional investors like Blackstone will have far-reaching consequences for the real estate market. Their moves can either stabilize a teetering market or send it tumbling down. The ripple effects of their strategies will be felt by homeowners and investors alike, potentially reshaping the landscape of real estate investment in ways that are only now beginning to unfold. Housing inventories in Florida have surged by over 40% year over year, a staggering jump that's reshaping the landscape for buyers and sellers alike. This shift is turning the once white-hot Florida real estate market into a cooler one, where the balance of power swings from seller to buyer. In 2021, during the peak of the real estate frenzy, Florida homes were selling faster than hotcakes at a county fair. Properties barely hit the market before they were snatched up, but fast forward to today, and the scene has dramatically changed. According to recent data from the Florida Realtors Association, the median time a property spends on the market has doubled compared to last year. Homes that once sold in a week are now lingering for months. What's more, the median sale price, which had been climbing steadily by double-digit percentages annually, has started to plateau. This year, some regions in Florida have seen price increases slow to a mere 2 to 3%, a sharp decline from the 15 to 20% annual increases witnessed over the past 2 years. This deceleration in price growth is a clear sign that the market is cooling. Inventory levels, a key indicator of market health, are showing signs of significant increase. Data from the National Association of Realtors shows that in cities like Miami, Tampa, and Orlando, inventory levels have risen from a tight 1.5 month supply last year to over 4 months supply now. To put that in perspective, a balanced market typically has about a 6-month supply of homes. This increase means buyers now have more options to choose from and less competition, leading to fewer bidding wars and more room to negotiate. But what's driving this sudden influx of homes on the market? Several factors are at play here. Firstly, many homeowners who held off selling during the pandemic are now looking to cash in, anticipating that the market peak has passed. Secondly, the end of mortgage forbearance programs has led to an increase in listings, as some homeowners opt to sell rather than risk foreclosure. Another critical factor to consider is the rise in mortgage rates. As rates climb, borrowing becomes more expensive, cooling off some of the fervor in the housing market. This year, mortgage rates have ticked up by over a full percentage point from last year, adding hundreds of dollars to monthly payments and sidelining some potential buyers. So what does this all mean for the future of Florida's housing market? While it's too early to declare a full-blown market crash, the signs point to a significant shift towards normalization. Prices are stabilizing and buyers are finding they have the upper hand for the first time in years. This shift could bring more sustainable growth and a healthier market in the long run. As we watch these trends unfold, it's crucial for anyone thinking of entering the housing market to stay informed. The days of wild speculation and frenzied buying might be cooling down, but understanding the current dynamics can help you make smarter, more informed decisions, whether you're buying, selling, or just watching from the sidelines. Institutional investors like Blackstone have been pivotal in driving market dynamics. In the early 2020s, these investors poured billions into residential real estate, snapping up everything from suburban homes to high-rise apartments. At its peak, institutional buying accounted for nearly 30% of all home purchases in key markets, a massive surge from just a decade earlier. But now there's a sharp pivot. Blackstone is offloading properties, signaling a shift that could have profound implications. Why does this matter to the average person? Because when these institutional behemoths move, they move markets. Prices, rental rates, and the very availability of homes can shift dramatically. For instance, when Blackstone and other institutional investors began buying up homes, they inadvertently pushed prices upward, pricing out many individual buyers and altering neighborhoods. The statistics are telling. In areas heavily targeted by these investors, home prices soared by an average of 15 to 20% above the national growth rate during their most aggressive buying phases. Moreover, rental rates in these regions have risen by nearly 40% in just the last 5 years, outpacing wage growth and increasing the cost of living for everyday residents. But what happens when they sell? The current sell-off by Blackstone is releasing a significant amount of properties back onto the market, potentially leading to a stabilization or even a decrease in home prices in those areas. This could be good news for first-time home buyers who've been sidelined by the steep competition and high prices driven by institutional capital. However, the impact goes beyond just prices. The presence or absence of these investors affects local economies, construction trends, and even the fiscal health of communities. As these investors retract, we might see a slowdown in new construction projects, less speculative buying, and potentially more opportunities for local and individual investors to enter the market. Moreover, Blackstone's current strategy could forecast broader economic trends. If they're selling due to anticipated market cooling, this could be an early warning system for smaller investors and homeowners to brace for a shift. For markets where institutional investment has been a backbone, like in Florida, this retreat could herald a significant change in market dynamics, impacting everything from property values to rental demand. As we continue to monitor this trend, the key takeaway is clear. The actions of institutional investors like Blackstone are bellwethers for the real estate market. Their buying sprees can supercharge a market, and their sell-offs can cool it down. For anyone involved in real estate, keeping an eye on these players offers crucial insights into potential market movements and opportunities. When Blackstone starts selling, it's not a simple reduction in their portfolio. It's a signal that could potentially trigger a market-wide reaction. Historically, when institutional investors pull back, the effects can ripple through the economy in significant ways. For homeowners in Florida, the immediate impact could be a welcome relief as the housing inventory, which has been tight, begins to loosen. More homes on the market mean more choices and potentially lower prices, which could help first-time buyers and those looking to upsize or downsize. However, for investors, especially those who entered the market at its peak, the scenario might not be as rosy. If others follow Blackstone's lead, we could see a sudden increase in supply, leading to falling prices. This is particularly critical in a market like Florida, where investment properties and second homes make up a significant portion of real estate holdings. For those investors, the value of their investments could decline, impacting their returns and possibly leading to a sell-off, further exacerbating the market shift. For the overall economy, the effects are even broader. Real estate is a key economic driver in Florida, involving not just sales, but also construction, renovation, and a host of related services. A slowdown in the real estate market can lead to fewer jobs in these sectors, potentially slowing down the local economy. Moreover, property taxes, a significant source of revenue for local governments, might see a dip if property values decrease or if sales volume declines, affecting public services and infrastructure funding. Looking into the future, if this trend continues, we could be witnessing a significant transformation in the Florida real estate market. This might not be a sudden crash, but a gradual shift towards a more balanced market. However, if investor confidence starts waning and more begin to exit, the shift could be rapid and more dramatic. It's essential to watch how other institutional investors react. If Blackstone's move is an isolated case, the impact might be limited. But if it's the start of a trend, the consequences could reshape the housing landscape in Florida. Will other investors hold steady, or will they too begin to offload properties? The answers to these questions will shape the real estate market in Florida in the coming years. Did you know that Florida's housing market, known for its relentless rise in prices, might be showing signs eerily similar to the pre-2008 crisis? Today we're diving deep into how the current market conditions compare to those of previous market downturns, bringing some historical context into the mix. Let's rewind a bit. Before the 2008 financial crisis, Florida's real estate market was booming, with prices soaring and investors pouring in from all corners. Fast forward to today, and we've seen a similar pattern, a rapid increase in housing prices spurred by low interest rates and significant investor activity, including major plays by institutional investors like Blackstone. But as we've seen in the past few months, Blackstone is starting to sell off their assets, which raises the question, are we on the brink of another downturn? Historically, a sudden shift in investor behavior has been a precursor to broader market corrections. For instance, in the year leading up to the 2008 crash, there was a noticeable increase in the inventory of unsold homes, much like what Florida is experiencing now. Back then, the inventory jumped by over 25% in just 1 year, a red flag that was largely ignored. Today, we're seeing a similar trend, with a significant rise in unsold inventory levels across the state. Moreover, the rate of home price appreciation in Florida has shown signs of slowing down. While the average annual price increase was around 10 to 15% during the pandemic's peak years, recent data suggests it's now hovering around 5 to 7%. This declaration is another indicator that the market might be cooling off, reminiscent of the trends observed just before previous crashes. Another critical factor to consider is the affordability index, which measures the average consumer's ability to purchase a home. Just before the 2008 crash, this index plummeted as home prices outpaced income growth, making housing increasingly unaffordable. Today, despite higher wages, the rapid increase in home prices over the past few years has once again pushed the affordability index to concerning lows. Thanks for watching, and please make sure you subscribe if you enjoyed the video and watch this one as well.